The P&L account goes by many names: profit and loss, or P&L, statement, income statement, and the statement of revenue and expenses. They are all really the same thing. The P&L account is a financial statement that shows a company's financial performance over a period of time. A company's financial performance is reflected in its revenue, expenses, and profit. Revenue, also known as sales or turnover, is the money made from selling a product or service. Expenses are the costs of running the business. These are direct, called cost of sales or cost of goods sold, COGS for short, or indirect. Overheads like paying staff, rent, utilities, etc. Profit is the money left over from revenue minus expenses. P&L accounts are usually made quarterly or yearly. Different sectors and companies may have different rows included in their financial statements. I'll show you a basic income statement for a restaurant and talk you through it. I've already explained revenue, so I'll move on. COGS stands for cost of goods sold. These are all the direct costs that came with selling the product or service, in this case, food. COGS would include ingredients, takeaway packaging, napkins, condiments, etc. Operating expenses are the expenses taken from the ordinary day-to-day operations of the business. SG&A, RD, and depreciation all fall under operating expenses. SG&A stands for selling, general, administrative, which is rather self-explanatory. Stuff like payroll, management salaries, advertising, etc., usually fall here. RD stands for research development, also pretty self-explanatory. It's the costs from product development, new formulas and recipes in food, just anything to improve the product or service provided. Depreciation is probably best explained with an example. The restaurant bought a new oven for $10,000. The expectancy of this oven is 20 years, and the restaurant expects to make $400 yearly from this investment. This is called salvage. In accrual accounting, we assume the oven will be used for its entire lifetime, so instead of throwing financials out of whack, we spread the costs out over those 20 years. This is depreciation. So, the restaurant takes $400 from $10,000 to get the oven's total depreciation, then divides that by 20 years, giving it an annual straight-line depreciation of $480. Straight-line depreciation is a common and simple way to spread costs across time. There are other types of depreciation, like declining balance and double declining balance. They all serve the same purpose. You may be wondering what accrual accounting is. I'll explain it in a future video. It's a juicy topic. Interest expense is the money paid out to lenders from interest. Whenever you take a loan, you usually pay interest on the amount you borrowed. That interest is a business's interest expense. Income taxes paid are the taxes paid on the rest of the business's money. Corporations get to spend money before it's taxed. On the P&L account, there are usually three types of profit: gross, operating, and net profit. Gross profit is the money made after direct costs are subtracted from the revenue. Operating profit is that, but after operating expenses are out of the picture. Lastly, net profit is the money left over after everything has been paid. I hope you liked this video. A like and a sub would be very much appreciated. Thanks for watching.